In today's video, I'm going to talk about whether the federal government is going to be taxing your Roth IRA. Hey folks, this is David McKnight, best-selling author of The Power Zero and Tax-Free Income for Life. Today's video is an excerpt from an interview I did with John Rickgarn from the Wealth and Freedom Nexus. During this interview, I discuss whether the federal government is going to be taxing your Roth IRAs, how to avoid over-converting your Roth IRA, and much, much more. Have a listen.
I was curious about, like I said, I've read your books and listened to your podcast for quite some time now, and you always talk about in the tax deferred bucket, where obviously, we're at the risk of what tax rates are going to be in the future, of having the distributions, set to what the standard deduction is, for a married couple. I think off the top of my head, it's about $25,000 for a married filing jointly now. However, a lot of people, unfortunately, I don't think a lot of couples, die at exactly the same time, that, Mr. Smith passes away, then the next year for filing, Mrs. Smith doesn't do anything, but then she realizes, oh, I'm single now. The deduction now is half that $12,500, not $25,000. So I made all these arrangements. Now half of what was in that bucket that comes out every year is now taxable. Should couples maybe, I don't know, just saying, err on the side of caution? Should they just plan for just the single rate, so there isn't the single standard deduction, so there isn't a big surprise later on? Or
So the strategy, to summarize the strategy, we don't want to shift everything out of your IRAs or 401ks into the tax-free bucket, because if you do that, then you'll have a standard deduction in retirement that sort of sits idle, right?
Okay.
In other words, you will have paid a lot of tax to get money shifted from tax deferred to tax free. And now you won't be able to use that standard deduction, which means you shifted more than you really needed to, and you lost some money to the IRS along the way. So basically what the strategy says is, let's leave a nominal amount of money in that tax deferred bucket. Let's have that balance be low enough that the required minimum distributions are equal to or less than that standard deduction in retirement. Okay. And so, that starts at age 72. So the question is, when are Mr. and Mrs. Jones likely to die? Okay, well, once you reach 72, if you're both still alive, there's a really good chance that you're both going to reach age 85. The woman usually lasts 2 years longer than the guy. Mm-hmm. So let's say you start at 72, you start taking money out of there, have it offset by that standard deduction. As a married couple, $25,900 this year. That means you can have about $350,000 of a balance in that tax deferred bucket without causing Social Security taxation. So there's a lot of different things at play. So if you're at 72 and you're going to live to age 85, that's 13 years of being able to get tax-free distributions from your IRA or 401k. And if Mrs. Jones lasts 2 years longer than Mr. Jones, that's only 2 years where you'll have too much money in your tax deferred bucket, as it were, and only be able to offset those distributions by having the single taxpayer standard deduction. So I understand where you're coming from. I think it still justifies having the larger amount of money in that tax deferred bucket.
Sure. Okay. Makes sense. Yeah. And I don't know, I don't have a crystal ball. I've always kind of wondered if the standard deduction is going to be changed. I know, if they did away with it or lowered it, it'd probably be very, very politically unpalatable. But at the same token, back in the 80s, Social Security became taxable. So I'm at kind of the belief anything's possible, but that definitely makes sense. And have it go in tax-free, have it grow tax-free, and then have a portion of it come out tax-free, I think is the, holy trinity, so to speak.
Yeah. That's the way to go if you can. And that's why you want to be very careful about how much you convert from tax deferred to tax-free. You don't want to convert too much. You want the balance in that tax deferred bucket to be just the right amount. It means you minimize the amount you had to pay in tax, and then you can take that money out tax free.
Makes sense. So again, like I alluded to, neither one of us have a crystal ball, but obviously I think the government's going to be starved for revenue, especially with Social Security, Medicare, Medicaid, as well as, free education, free healthcare, everything else that's in the socialist utopia, so to speak. But what chance do you see of Roth distributions being taxed in the future, especially since 40 years ago, Social Security benefits weren't taxable. Now they are. I mean, with your background, your connections, your network from David Walker and everyone else, Do you think that's completely off the table? Don't worry about it, or is there some, is there some concern there?
Yeah, so you got to remember that only about one out of every $20 retirement dollars are in Roth accounts.
Okay.
So the ratio there is, people are addicted to tax deferred accounts. They love the tax deduction whether it's the tax deduction or just force of habit, they love putting money into their 401k and IRAs. They love getting the tax deduction today at historically low tax rates, mind you, but they love getting that tax rate. So most retirement savings are in tax deferred vehicles. So the target is not on the tax-free accounts. In fact, Roth IRAs are the one thing that both consumers and the federal government like. Why?
Okay.
Because you're using after-tax dollars, and that gives more revenue to the federal government today. Politicians don't care necessarily about what revenue is coming in 20 years down the road because they're not going to be in office. They want to know what's revenue is coming in today. So they love Roth IRAs because it gives them money today. But consumers love Roth IRAs because they can see that tax freight train bearing down on America, and they want to shield themselves from the impact of higher taxes. And one of the best ways to do that is to put money into a Roth IRA or permanent life insurance, some combination of the two. So, I don't see the Roth IRA going anywhere. Historically, they've always said, well, we'll either tax you on the seed or the harvest. And if they were to change that formula mid-stride, I think it would angry a lot of people. And so if they were to ever change it, they would say, whatever you have in there will continue to grow tax-free, but will no longer allow you to make contributions. I don't see that happening because they love getting the tax revenue today.
Gotcha. Makes sense. So, all right. Maybe as a final point, David, just, for all my listeners, and, I don't want to promote like a one size fits all approach per se, but just as we've talked, currently, inflation's about 8.5%. We're at a $30 trillion federal national debts growing by the minute. The stock market currently at the time of this recording is in a bear market. If there was like one piece of advice that you could give to anyone listening to this that would, probably be the most beneficial in this time and space, what would that be?
Well, okay, so let's talk about the impact of inflation. The Fed only has so many tools in their toolbox to deal with inflation, and frankly, they've sort of painted themselves into a corner. The way that they plan on dealing with inflation is by raising interest rates. The problem with that is not only does it potentially put a huge wet blanket over the economy, but now interest rates are going up and the cost of servicing the national debt is also going up. And if all interest rates did was, return to historically normal levels like what they were in 2003, the cost of servicing the national debt would like quadruple. And that's bad news because now we're getting to a point where servicing the national debt could consume the entire federal budget.
Wow.
So if the entire federal budget is consumed by servicing all of this burgeoning national debt, then where are they going to get money to pay for Social Security, Medicare, Medicaid, just the cost of running the federal government? So they're really painting themselves into a corner here. And so we will get to a day of reckoning where tax rates will have to rise dramatically or we go broke as a country. Now, they would probably print more money before we went broke, but that also doesn't solve the problem. That's right out of the Stephanie Kelton playbook. And we now know that causes lots of inflation. And so we go into this death spiral where the only real solution is that we have to have huge infusions of cash. And where do you think they're going to get that money from? Well, they're going to get it from you and me. They're going to raise taxes. And for Americans who have saved the lion's share of their retirement savings in 401ks and IRAs, that's bad news. And so right now, John, we are at historically low tax rates. Taxes are on sale. We know precisely when that tax sale is going to end, January 1st, 2026, which means that every year between now and 2026 represents a little mini window of opportunity within which to take advantage of historically low tax rates. And every year that goes by where we fail to take advantage of historically low tax rates by getting those tax deferred assets shifted to tax-free is potentially a year beyond 2026 when we could be forced to pay the highest tax rates we're likely to see in our lifetime. So I guess that's a long story short, get your money shifted to tax-free while tax rates are low.
Yeah, no, that makes sense. Yeah, my wife and I have done that for the last oh boy, 6 or 7 years, I think, now shifting to our Roth accounts. David, as we close off here, like I mentioned, you're the best-selling author of many books on Amazon that you can find. Are there any current projects you're working on in 2022 and into 2023?
Yeah, I've written a novel called The Infinity Code.
Okay.
And the subtext of that novel is basically a Dan Brown type thriller, but quick summary. In 1985, about 20 Harvard graduates got together and said, how do we change the world? How do we create a new world order? And their way of doing that was to adopt modern monetary theory. And they've fast forward to the present, 2020. It's actually 2020.
Okay.
One of their numbers is now running for president and is the leading candidate. And once he gets elected, they're going to change monetary policy forever with a lot of dire consequences. And so there's a Harvard sophomore that becomes aware of this plan, and in a race against the clock, he's got to figure out how to stop these guys. And the real purpose of this novel is not just to be sort of this summer beach novel, which I think it could function very well as, but as a way of educating America on the dangers of modern monetary theory, but to do so in sort of a fun, interesting, and suspenseful way. So that book is now being shopped out to about 10 different publishers by my agent. Okay. And so hopefully we hear something soon, and you'll be seeing that in a bookstore, before you know it.
Sounds good. Any target date for release, or hard to say?
No, we got to get a publisher. Okay. But my publishers are a bit like, great, Dave, if you want to write a business book, we'll publish that all day long. But as far as novels, they're not the same thing. So we're just waiting to see what publishers say. And if they were to say no, for example, I would just self-publish it, but probably next 6 months, something like that.
Gotcha. Okay. All right. Well, David, I want to thank you again for taking time out of your schedule for being on my show and educating my listeners on, strategies they can take to mitigate their tax environment. If anyone's interested in learning more about you, or maybe even reaching out to an advisor that you've vetted that has the power of zero philosophy, what's the best way to do that?
Yeah, so there's two ways to sort of plug into what I do. The first way is you can watch my YouTube channel. That's The Power of Zero. We post videos twice a week. And if anyone's interested in this type of planning, you can just head over to davidmcknight.com. Happy to give an opinion on what you're doing.
Sounds good. And for those of you listening or working out or driving, I'll have all these links in clickable format in the show notes. So, all right. Well, again, David, I want to respect your time and thank you again for coming on the show, and very much looking forward to the Infinity Code when that hits bookstores.
All right. Thanks, John. Really appreciate it.
If you need help protecting your retirement savings from the impact of higher taxes, head on over to davidmcknight.com. I'm happy to lend a hand. If you have any comments or questions, don't hesitate to put them in the comment section below. This is David McKnight. I look forward to seeing you on the next video.